Hi, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at LLC Private Wealth and CG Wealth Management. Thanks for joining me for a quick recap of the markets for March 2025. Of course, we do have to jump in at the end here. We're going to cover the first couple of days of April and what's been going on with the recent market meltdown since the Trump tariff war has been announced. But let's look at what's moved the markets here in March and what that means for the tactical portfolios and what's going on in there. So welcome to the March Tactical Portfolio Review. We have a lot to cover, so let's jump right into things. First of all, let's take a look at what the markets have been doing in March, and it's been a pretty mixed bag across global equities, especially here in North America. Canada, the TSX Composite ended the month slightly negative, down about 1.87% for the month of March, driven mostly by overall economic weakness. That's the trend we've been seeing continuing since December in Canada. We did see some strength in energy, materials, and the Canadian financials kind of remaining relatively flat, and we'll talk a little bit more about that. South of the border in the U.S., we've seen a bit more volatility. The S&P started its downward trend in March after several months of continued good performance. They're losing about 5.75% in March, hurt mostly by the tech and consumer discretionary sectors. NASDAQ also posted a loss of 3.4%, mostly around the optimism of AI and its economic productivity impact. The outlook of that starting to weaken a little bit as people start to see that play out over the next little while. Of course, here in Canada, as I mentioned, the energy stocks slightly higher with the oil price being pretty strong, and then at $74 a barrel by the end of the month, mostly due to continued geopolitical tensions as well as renewed OPEC plus production cuts. Gold had a great month, breaking through the $3,100 US dollar level for the first time. Big benefit for the Canadian gold producers, although the producers' stock price still struggling a little bit, still had a decent month, kind of showing a bit of gains, despite the all-time high on the gold price. Bringing a little bit of shine to anyone with a resource-heavy portfolio for sure. Now, that being said, of course, the Bank of Canada in March also cut their rates, reducing the overnight rate down to 2.75, pretty much on par as expected. They did signal continued reductions in 2025. The street is pretty much estimated by July will be down to 2% in Canada. Now, as we will talk about in a few moments here, April developments might change that view a little bit, might change the outlook a little bit, depending on how we wrap this month up. So we'll have to keep a close eye on that, but that's the current expectation. A couple more cuts get us down to about 1%. From a currency standpoint, the Canadian dollar held relatively steady against the US, hanging around the 70-cent mark. This helped cushion some of the returns on the US assets versus Canadian assets, especially anyone who has those unhedged exposures. Now, remember, in the portfolio in December, we did reduce our exposure to the US dollar, taking advantage of the spread when we got below the 70-cent mark back in December. We still think the Canadian dollar has opportunity to close that gap a little bit here in 2025, where we might look at rebuying some of those US dollars that we took out back in December. But as right now, again, April kind of puts everything up in the air, as we'll talk a little bit more about that. So what's going on in the tactical portfolios? Well, as I mentioned, the Canadian market's almost 2% down, the US 5% plus down. So a bunch of negativity in there. Of course, the portfolio is designed to offset some of that risk when we get into more volatile periods, and we certainly saw it doing that. March, we saw less than a 1% drop in light of the broad market negativity out there. They're holding in very well. This is mostly due to the defensive shifts we made back in December, as I mentioned. We lightened our U.S. exposure. We shifted away from consumer discretionaries and more to consumer staples. We got good grocery store exposures. We've got power and utility exposures in the portfolios. All more defensive sectors, especially if we're going into economic slowdowns. And also through all those shifts, we're sitting between 15 and 20% in high interest cash in the portfolios. And again, it wasn't predicting what we're seeing here in the markets. It was mostly preparing for what we expected to be a period of uncertainty as the new administration in the U.S. Got into place. We didn't know what they were going to be doing or how they were going to be doing it, but we did know, that we would definitely see something happening through that period. So we made those shifts back in December, and that's playing out really well for that defensive stance. We continue to hold that defensive stance. We haven't deployed any of that cash or made any shifts yet, but we're keeping a close eye on things, what's going on. So with that, let's jump right on top of what's going on in April. The first couple of days, the markets have completely gone into the negatives. These numbers are as of April 4th. So, things might have changed by the time you see this video, but the TSX fell over 2 days. In the first 2 days of April by almost 7%, 6.92%. S&P off 9.58% on top of what it fell in March, and the NASDAQ off 12.8% as well on top of what it lost in March. So we've seen a big impact of the tariffs hitting the markets out there. I'd like to say there were some safe areas, really not too many safe areas out there. So we have seen some impact on the portfolios. They are still holding in really well as of time of the filming. I don't have the updated numbers, but they're being impacted obviously much less than those numbers I just gave you in the market, just like we saw last month where they experienced about a quarter of March's volatility or downward volatility. They're kind of in line with that. I won't have those exact numbers for another day or so, but we're seeing the defensive stance hold. And that's what we want. It's okay if we see a bit of volatility, because remember, volatility is a shopping opportunity, especially where we have that cash in the portfolio or less volatile positions where we can take advantage of dips in some of the good names that are out there. So we're not worried right now. We do hope all these tariffs are negotiation tactics, and that this should be fairly short-lived. But the longer it stays, the longer it might be impacted. We've seen oil impacted massively, coming down into the low 60s. Of course, that impacts Canadian economy quite a bit, as well as our currency, and as well as what might happen with our interest rate. So going back to that 2% expectation by July, that might come into question, depending on how long this lasts. And of course, in the U.S., some of the bigger sectors being hit, technology, anything around growth names, the retail sectors, the consumer discretionary sectors are having a large impact, as a lot of their manufacturing are in foreign countries that are being hit with bringing the tariffs, bringing their goods back home. The automotive sector, all these areas are being hit, with the biggest impacts with the recent pullbacks. We are seeing, so today's the April 7th. We have seen the markets whipsaw back and forth between negative and positive and negative. It still seems to be a lot of uncertainty and probably a little bit more damage out there. Maybe we're coming to a bottom or consensus bottom. Won't be able to sell that probably for a couple more days. But obviously, we're going to keep a very close eye on that and keep you updated. So where are the takeaways for that? Well, March and April is a reminder of the importance of using a tactical approach across both sectors and geography. While this volatility remains a part of the landscape, there are real opportunities out there if you're positioned properly to take advantage of it. And that's what the tactical approach is designed to do. And that's what it's looking to do and has been doing so far to this point, and it should continue to. So stay confident with what's going on. We're happy so far with how the portfolios are holding in. If you have any questions about any of these developments about your portfolio, especially if you have a portfolio, an external portfolio that's not tactical, those benchmark kind of balanced mutual fund type portfolios, they really get hit in these periods of time. They go for the full ride. So if you want to take a look at how those are being affected, and whether you want to just have a review of those and take a different look at them, don't hesitate to reach out. We're always happy to do that. Reach out to us with any of your questions or any concerns you have whatsoever. As always, you can reach us in the links in the video down below, llc@cgf.com. You can reach us. You can find our website. The quick way to get to my website is mikeonmoney.com, and that's our team website as well. So that's it for the March update and the early peak at April. April's definitely going to be an interesting month, so we'll keep you apprised of everything that's going on. Of course, with that, thank you for watching our monthly update. Look for more videos from us this month, and I'll see you next month as we update things then. Goodbye now.